Welcome to The Deep Dive, your ultimate shortcut to being well-informed.
Glad to be here.
Today, we're taking a really close look into Byrna's fiscal second quarter 2025 earnings.
Yeah, big quarter for them.
We're going to unpack the company's recent performance, explore some pretty innovative strategic shifts they're making, and consider what their future outlook might be, especially, in this kind of dynamic market.
Exactly. This quarter for Byrna isn't just about the raw numbers. It really shows their agility. We'll be connecting the dots between those financials and the strategies they're using. Pretty forward-thinking stuff.
Right. To not just grow, but maybe even reshape their whole business.
That's the sense I get.
Okay, let's dive straight into the numbers then. Maybe start with just a quick snapshot of Byrna's Q2 2025 results.
Sure. So net revenue for the quarter came in at $28.5 million.
$28.5 million. And how does that compare?
That's a remarkable 41% jump year over year, up from $20.3 million in Q2 2024.
Wow, 41%, especially when you hear about consumer spending slowing down generally.
Exactly. That kind of growth, well, it tells you something about how they're executing their strategy. It's not just market lift.
Okay, what about profit?
Gross profit landed at $17.6 million. That maintained a solid 62% of net revenue. Pretty consistent margin there.
And net income?
Net income saw a bit of a bump, hitting $2.4 million compared to $2.1 million the year before.
Okay, a modest increase.
Yeah, modest. But remember, this was while they were making some pretty big investments in inventory and expansion. So it suggests the underlying profitability is strong, even as they're scaling up fast.
That's a good point. And adjusted EBITDA, I know that's a metric people watch.
Right, the non-GAAP one.
Yeah.
Gives a clear picture of core operations. That reached an impressive $4.3 million, up significantly from $2.8 million.
Okay, so operationally looking stronger. Now the balance sheet stuff, cash and inventory. I saw cash dipped.
It did. Cash equivalents, and marketable securities decreased to $13 million. That was down from $25.7 million.
Okay, that sounds like a big drop. And inventory went the other way.
Yep. Inventory jumped quite a bit, up to $32.3 million from $20 million.
So less cash, more stuff sitting in warehouses. At first glance, that might worry some people. What's the story there?
That's a really crucial point to understand. This wasn't some kind of red flag. It was actually a very deliberate, planned increase in inventory.
Planned? Why?
Specifically ahead of their big product launch, the compact launcher, the CL. They were building stock for that.
Ah, okay. So stocking up before the expected demand hit.
Exactly. Combine that with just normal seasonal working capital movements, and it shows them preparing for significant future sales, not, struggling with cash flow.
Gotcha. And it's worth mentioning they still have no debt, right?
Correct. No current or long-term debt. That gives them a very strong, unencumbered financial foundation to operate from. Makes moves like building inventory less risky.
Okay, so the numbers show growth, some shifts in the balance sheet, but it sounds like that was strategic. What actually fueled this growth, though? Let's get into the specifics.
Right, the strategies behind the numbers.
Starting with what seems like the biggest piece, the compact launcher. The CL. You mentioned it drove the inventory build. Sounds like it drove revenue, too.
Oh, absolutely. The CL launch really catapulted Byrna to this new quarterly revenue record. It was the main engine behind that 41% year-over-year growth.
And that's even more impressive because consumer spending was supposedly slowing. And didn't they mention sales were a bit soft before the launch?
They did. April was apparently subdued. Seems like people were holding off, waiting for the CL to drop, which tells you something about the anticipation.
Makes sense. And now it's available more widely. I saw something about Amazon.
Yeah, it hit Amazon on May 27th, and it was included in Prime Day sales, too. That's a big visibility boost.
But selling on Amazon, doesn't that usually kill margins?
You'd think so, right? But here's what's really insightful. Byrna managed to keep their net margins for Amazon sales comparable to their own Byrna.com sales. Well, they figured out the cost side. Savings on credit card and Shopify fees, lower outbound freight costs compared to direct shipping, and crucially, lower advertising costs because Amazon brings the traffic.
Huh. Smart. So they cracked the Amazon code for profitability?
Seems like it. It's a huge win if you want to scale efficiently using these big platforms.
And the CL product itself, it's not just driving volume, it's better for margins too.
Yes, significantly better. We're talking a 7 to 8 percentage point advantage over their other launchers.
Wow. So every CL they sell is quite a bit more profitable. What makes it different physically?
It's engineered for concealed carry, really. It's 38% smaller and 36% lighter than their Byrna SD model.
Okay, but smaller and lighter, but powerful.
Yep. They say it's as powerful as the Byrna LE, which is their law enforcement model. And it's also 27% narrower than their current pistols. So smaller, lighter, powerful, and easier to conceal. Checks a lot of boxes.
Definitely sounds like a product designed to hit a specific market need. Okay, let's shift to distribution. How are they getting these products out there? The Sportsman's Warehouse deal sounded important.
Oh, it was huge. A key driver this quarter. That partnership contributed $2.4 million just from the initial stocking order.
$2.4 million out of how much total dealer sales growth?
Total dealer sales increased by $3.9 million. So Sportsman's was the lion's share of that growth. And overall dealer sales were up 106%. Massive jump.
Okay, so Sportsman's is a big deal. How many stores are they in now?
Currently, 59 Sportsman stores are stocking Byrna products.
And what does that look like inside the store?
It varies. They have 21 store-within-a-store locations. 14 of those actually have dedicated shooting pods for demonstrations.
Yeah, you can try it out.
Seems like it. The other 7 store-within-a-stores use existing archery ranges. Then the remaining 38 locations have simpler point-of-sale, or POS displays, maybe end caps.
Interesting mix. And I heard something counterintuitive, that sometimes the simple displays are doing better.
Yeah, that was a surprising finding they mentioned. Some of those basic POS locations are apparently outperforming the full store-within-a-store setups.
Huh. Any idea why?
They're digging into it.
Yeah.
Is it just foot traffic in that part of the store? Store demographics? Maybe the specific staff? They're analyzing it?
And they're trying things to boost performance?
Definitely. They're deploying what they call burner geniuses. Basically trained brand experts in 12 of the Sportsman's locations already, with plans to expand that.
Like dedicated salespeople.
Sort of, yeah. Plus, they mentioned using SPEFs, that's like small bonuses or incentives for the regular store employees to push Byrna products.
Makes sense. And the expansion plans with Sportsman's, more stores.
Yes. They're installing 9 additional shooting pods, which will bring the total to 23 pods and 33 store-within-a-store locations overall.
Okay.
And then another 72 stores are set to receive the POS display. So the goal is to be at about 140 Sportsman's locations by the end of the year.
Wow, significant ramp up. They also mentioned celebrity endorsers helping drive traffic.
Yeah, specifically Tucker Carlson. Apparently, his endorsement drove noticeable traffic to Sportsman's Warehouse locations. Shows the power of influencer marketing in this space.
Interesting. Is the retail expansion just Sportsman's, or are others getting involved?
It's broader now. They're seeing increased interest from other outdoor and sporting goods chains. Big Five Sporting Goods and Shields, for example, are not only carrying Byrna, but expanding the number of stores and the range of products they offer.
So deepening relationships with existing partners.
Right. And new chains are testing the waters too, like Dunham Sports.
Okay. But the really interesting bit, I thought, was the expansion into totally new types of stores.
Yeah, the farming and ranching market. That's a big move. Rural King and Family Farm and Home are now starting to stock Byrna products.
Tapping into a whole new demographic.
Exactly. And if you connect this broader brick and mortar push to the current economy, falling consumer confidence, tariffs maybe biting.
Right.
This diversification is really smart. It's how you navigate those headwinds. Find new customers where they are, even in places you might not have thought of before.
Like farms and ranches. Okay, what about their own stores? They have a few company-owned locations, right? How are those doing?
Exceptionally well, actually. The stores in Scottsdale, Nashville, and Fort Wayne all hit profitability within just 5 months of opening.
5 months? That's fast for retail.
It is. In May, they averaged $69,000 in sales per store. If you annualize that, it's around $800,000 per store, which they said is well above their break-even point.
Any standouts?
Scottsdale is apparently doing as well as their long-established Las Vegas store, which is impressive. And Fort Wayne was a surprise performer, strong results, despite being in what they described as a smaller, less affluent community.
So the model works in different environments. Are they planning to open a lot more of these?
No immediate plans for more company stores, they said. But it clearly offers long-term potential in certain markets. And maybe more importantly, it gives them really valuable direct insights into what works at retail.
Insights they can share with their partners.
Exactly. They mentioned they've actually revised their premier dealer program based on learnings from their own stores, offering more generous pricing and even price protection for dealers who commit to higher annual volumes.
Okay, applying lessons learned. Let's pivot slightly international sales. How's that looking?
Pretty strong growth there, too. $2.6 million in international sales for a quarter. That's an 86% increase year over year.
86%. Wow. Was there anything unusual in that number?
Yeah, there was a one-time royalty bump included from Byrna LATAM, their Latin American partner.
Ah, okay. And what's the situation with Byrna LATAM?
Byrna still has the option to buy them back. They sounded pretty encouraged by their success down in South America. The hint was they might exercise that option down the road, once LATAM is consistently profitable and can pass all the U.S. public company audit requirements.
So keeping options open for future international consolidation.
Seems like it. Shows a long-term view.
Okay, let's talk marketing. This is where some really interesting, almost futuristic stuff came up. Influencers first.
Right. They're expanding their influencer strategy. The Tucker Carlson edition was successful, as we mentioned, and they said they're in talks with other maybe broader appeal celebrity endorsers now.
That's standard playbook, maybe? But the AI part, that sounded different.
Oh, yeah, that was fascinating. They're using artificial intelligence to massively speed up content production.
How so?
Basically creating lots of ad variations, tailored content for different platforms, much faster and cheaper than traditional methods, allows them to increase advertising frequency and maybe test messages more effectively.
And the example they gave was a banana.
The banana commercial.
Yeah.
They created an entire ad featuring a banana using only AI.
Why a banana?
It was apparently a genius workaround. Many platforms restrict advertising showing their actual less lethal products. So the AI-generated banana ad let them advertise something visually engaging, bypass the censors, and still get their brand message across, all at basically zero cost.
Huh. That's clever and probably got a high return on investment.
Exactly. It's not just quirky. It signals a really agile, tech-forward approach to marketing, especially for products in sensitive categories. It's a real competitive edge.
Definitely thinking outside the box. Okay, manufacturing and product strategy. They ramped up production before the CL launch.
Way up. They hit 254,000 units per month across all launchers to build that inventory we talked about.
254,000 a month. That's huge. What are they doing now?
Now that the initial stock is built, they've reduced production to a more steady state around 15,000 units per month, covering all their launcher types. But crucially, they said they have real-time adjustment capability now. They can ramp up or down quickly based on demand.
More flexible. And they mentioned positive cannibalization. What's that about?
Yeah, that was about the CL eating into sales of their older LE launcher.
Isn't cannibalization usually bad?
Not in this case, they argued, because the CL has much better margins, remember. That's 7 to 8 point advantage. So if customers are switching from the LE to the more profitable CL, that's actually a win for Byrna's bottom line.
Okay. Trading up to a higher margin product? Makes sense. Any changes to how they actually make the products?
Yes, a significant shift. They moved away from traditional assembly lines to a more efficient pod-based manufacturing system.
Pod-based?
Yeah, sounds like smaller, maybe more specialized teams or cells. They said it reduced labor needs and improved first-pass yield, meaning fewer defects right off the line.
Improving efficiency and quality.
Exactly. And that ties into their onshoring and reshoring initiatives too. Bringing production closer or back home is apparently improving quality control and reducing manufacturing variances.
Okay, lots of moving parts on the operational side.
Yeah.
Now, this next bit sounded like potentially the biggest long-term shift, recurring revenue.
This is huge, potentially transformative for how the company is valued.
First up is something called Byrna Care. Launching soon?
Yeah, Q3 launch planned. Think of it like an insurance policy or an extended warranty for your launcher.
What does it cover?
It offers no questions asked replacement if your launcher is lost, stolen, damaged, or even confiscated. You pay a monthly or annual fee for that peace of mind.
Interesting. Creates a direct service relationship with the customer after the initial sale.
Precisely. And then there's the really futuristic part, the smart launcher chipset, planned for next year.
Okay, putting a chip inside the launcher, what for?
To enable subscription-based smart features. This is the core of the recurring revenue play.
Like what IDA features?
They talk about the launcher communicating with your phone.
Yeah.
In a self-defense situation, it could automatically trigger geolocated calls to preset numbers, 911, campus security, maybe family members. They estimated that service might be like $5.99 a month.
Wow. Okay, that's a serious safety feature. Anything else?
Yeah, also integration with smart homes. Imagine activating all your house lights if the launcher goes into defense mode. They estimated that might be around $3.99 a month.
So layering services on top of the hardware.
Exactly. And think about the potential scale. They mentioned having over 650,000 Byrna units already out there in the market. If even a fraction of future buyers, or maybe even existing owners via upgrades, subscribe. That's a substantial, sticky, recurring revenue stream.
Yeah, that fundamentally changes the business model from just selling a device to selling an ongoing safety service.
It really does. It's a pivot from being just a hardware maker to becoming a personal safety technology and services platform. That could completely change how investors look at the company.
Okay, fascinating stuff. Finally, let's wrap up with the broader market context and their outlook. Did they mention anything about current events influencing sales?
They did note a temporary sales uptick back in June during some periods of civil unrest. Sales jumped about 40% that week.
But they saw that as temporary?
Yeah, they specifically called it transitory, not something they're baking into long-term forecasts. They also talked about the continued normalization of the less lethal product category, it becoming more mainstream.
And the impact of media appearances.
Earned media, like their CEO being on NBC and Fox News discussing tariffs, seems to be helping raise awareness and legitimacy for the category and the brand.
So what's management's overall outlook, despite the consumer headwinds?
They expect to keep growing. Their guidance was for top-line revenue growth between 25% and 40% for the full year.
25 to 40%, based on what?
Based on that expanded distribution we talked about, the continued product normalization, the earned media, and the impact of the CL.
And more product variations coming?
Yes, specifically more variations of the CL across different price points. They acknowledge some consumers experience sticker shock with the initial CL pricing, so they want to offer options to target a broader demographic.
Smart. Address the affordability concern. And what about the cash position? They expect that to recover.
Yes, as those high inventory levels built for the CL launch start to sell through and normalize in the coming months, they expect the cash position to rebound.
Okay, that paints a pretty comprehensive picture. Now let's put on our investor hats for a moment. For experienced investors listening, what's the big narrative here? How do all these pieces fit together?
Right, pulling it all together. I think the key narrative for investors is seeing a company strategically navigating a tricky consumer market, not just surviving, but aggressively repositioning itself for future growth.
How so?
Well, first, that aggressive expansion into diverse retail channels. Sportsman's, yes, but also Dunham's, Rural King, Family Farm and Home. Moving beyond the typical sporting goods store into farming and ranching, that suggests they see a much larger potential market than maybe previously thought. They're not waiting for demand, they're going out and creating access in new places.
Okay, broadening the reach significantly.
Second, and this is critical, is that deliberate shift towards recurring revenue. Byrna Care, the smart launcher subscriptions.
Yeah.
This isn't just an add-on, it's a potential fundamental pivot.
From hardware to services.
Exactly. From a company valued maybe like a traditional manufacturer to one valued more like a tech or services company with sticky, predictable revenue streams. That could command a much higher valuation multiple if they execute well. The market might not be fully pricing that transformation in yet.
So potential for re-rating. What else stands out?
Their data-driven approach. They're paying attention to subtle consumer signals, higher abandoned cart rates online, that sticker shock feedback, and using it to inform strategy, like planning those CL variations at different prices.
They're listening and adapting.
And they're actively managing performance in their new retail partnerships. The Q&A insights about why Scottsdale store works well, location, demographics, maybe great staff, and how they're using training like the Byrna Geniuses and incentives like spiffs to lift performance elsewhere, that shows active management, not just hoping for the best.
Proactive problem solving.
Right. And finally, you can't ignore the innovation in product and marketing. The CL itself, the AI commercials, the celebrity deals. In a category that often just relies on retailers fulfilling existing demand, Byrna is actively creating demand. That's a crucial differentiator.
Okay, so the picture is one of aggressive expansion, strategic pivot to services, data-driven adaptation, and demand creation.
That's a good summary of the investment thesis developing here.
All right, perfect setup for our next segment. Let's shift gears to something a bit more speculative, but grounded in everything we've just discussed. We call this our outrageous but plausible trade idea.
Designed to make you think.
Exactly. Pitched like you're a hedge fund analyst making your case. What have you got for us today?
Okay, here's the idea. A long position in Byrna paired with a short position in a, let's say, legacy personal safety hardware company, maybe one that's more single product focused, lacks Byrna's channel diversification, and crucially, has no real path towards recurring revenue.
Interesting. A pair trade. Long Byrna, short legacy safety, Inc. What's the rationale?
The core rationale is that Byrna is undergoing this significant transformation we've been talking about. It's evolving from just selling less lethal launchers direct to consumer into a broad, personal safety technology and services platform.
Right, the platform idea.
That aggressive push into all sorts of brick and mortar, retail, Sportsman's, Dunham's, but especially rural King, family farm and home, tapping into that farming ranching demographic, it suggests their total addressable market, their TAM, is much bigger than the market currently perceives for a company like this.
Okay, bigger market potential.
Then you layer on the high margin recurring revenue, Byrna Care, that replacement insurance, and the upcoming smart launcher subscriptions, geolocating, emergency calls, smart home stuff. That's a fundamental shift towards a sticky customer base with high lifetime value, or LTV.
Customers who pay month after month, year after year.
Exactly. Wall Street loves that predictability, and it's not something you typically see or get valued for in a traditional hardware company. That transition isn't fully baked into Byrna's current valuation, I'd argue.
And the innovation angle.
And the innovation, yeah. Their marketing agility. The AI banana commercial is the perfect example, plus the strategic influencer partnerships. It shows a tech-forward, nimble approach to building the brand and penetrating the market that you just don't see from older, maybe more stagnant players.
So the thesis, in a nutshell.
The thesis is that the market is underappreciating Byrna's multiple growth paths. The retail expansion, the new demographics, the recurring revenue, and especially its transition to a potentially higher multiple business model. Meanwhile, the legacy hardware competitor you're shorting is stuck in the old model and likely faces stagnation or decline. You're betting on that divergence.
Outrageous, but plausible. Captures the dynamic shift Byrna seems to be making.
That's the idea.
What a deep dive we've had. Byrna's Q2 really showed strong growth, fueled mainly by that new compact launcher.
The CL was key.
But also driven by really aggressive retail expansion and a very forward-thinking, almost tech company approach to marketing and future products.
Indeed. The potential for continued top-line growth certainly seems there, based on everything they're doing. But, for me, the really critical long-term story is that pivot towards recurring revenue. Byrna Care, the smart launcher. That could fundamentally change the company's future profile.
Absolutely. Now, before we wrap up, the important reminder, this is not financial advice.
Definitely not. We encourage you to do your own homework, your own due diligence before making any investment decisions based on anything you hear here.
Always think critically about the information and how it applies or doesn't apply to your own individual situation and strategy.
Couldn't agree more.
So as a final thought to leave you with, what does Byrna's evolution really mean for the personal safety market overall? Think about how this shift, moving from just selling hardware to building this comprehensive safety platform with ongoing services, how that might redefine what leadership looks like in this entire space going forward. Something to mull over.